So here you can see 3 pie charts with 17%, 10%, and 4%. If I were to show you this and say, do you think the people who own these pies are very rich? You might think, well, no, they own so little of the pie. But if I then said, this is Tesla, this is Amazon, and this is NVIDIA, would you all of a sudden then think, oh wait, this is Jensen Huang, Elon, and Bezos, some of the richest people in the world, who are all centibillionaires and now at this point, multi-centibillionaires. And so these incredibly successful people understood the first path of getting ultra wealthy, which is the combination of other people's money into your business. Now, the way that it works is that you raise funds by selling a percentage of your company. So what this does is that it actually dilutes you as a founder, meaning you no longer own 100% of your company, but now you might own 80% of a company that now has an extra $20 million, for example, that you can then use to grow. Now, there are some businesses that this is the only strategy to successfully, realistically accomplish the goal. And then there are some businesses that this would be a terrible idea to pursue. Now, one thing that I think took me way too long to understand as an entrepreneur is that every single business incurs debt the moment you start it. The question is what type of debt you're going to incur. And so, for example, if you bootstrap a business, as in you take no outside capital when you start it, you just fund it yourself and you own it and you grow it organically, then the debt that you take on is going to be that you're not going to have enough money to get the best talent in the door. And so you're going to have talent debt. You're probably not going to have enough money to get the right technological infrastructure in place to run the entire business. So you'll take on technological debt, right? And you can go down the line and start thinking about all the other ancillary non-financial versions of debt. Now, businesses that choose to take on financial debt choose to take on that debt instead of the other types of debt because of the nature of the competitive dynamics of the market they're in. And so those types of businesses typically are in businesses that take a tremendous amount of capital to start up and scale, or they're in winner-take-all markets where speed is the primary objective of the business so that they can capture the opportunity and then fundamentally become monopolies of a new type. So Facebook, for example, became a monopoly of attention to a large degree. Now, because there are other social media platforms, they get away with that, but they have created a big moat around all of the attention that exists in media. And so for them, there's only one real big social network that was going to exist. And so they then captured it. Of course, LinkedIn was like, well, is there a version of that we can do for business professionals? And then they captured that. Now, can you imagine now another professional social media platform being like, oh, we're now starting up. It's like there's no room for you, right? It's already done. That market is captured. And so when there were other companies that were competing for the same market, and the people who were able to raise the most money, spend the most money the fastest, attract the best talent, were able to capture it the fastest, then sealing their competitive moat to keeping that as a long-term cash cow over the long haul. Which means that those businesses lose a tremendous amount of money for a short period of time, and then they're able to kind of get over the hump and then become cash machines. And so, for example, Amazon was unprofitable for 9 years, famously. And there's an interview of Jeff Bezos getting grilled on the Tonight Show, I think, with Jay Leno. Is it Jay Leno? Yeah, with Jay Leno. And he's like, you guys don't make any money. And Jeff Bezos just gives it, he does this like weird laugh. And he's like, yeah, we don't, but we could. We just choose not to because we get better returns on our capital by continuing to expand our infrastructure so that we can eventually support literally delivering things the next day to every single customer in America. Notwithstanding the fact that they have the single most successful subscription in history in Amazon Prime. More people are subscribed to Amazon Prime than own a Bible. They have over 300 million subscribers. That's almost every single person in America is subscribed to a digital subscription for $99 per year, which I think now is $135, to have the ability, the privilege of shopping on their platform and getting faster shipping. And so when Bezos was making the investment of capital into the business, he asked the question, not what do I think is going to change in the next 10 years? He said, what things won't change in the next 10 years? And so he realized that there are some fundamentals that will never not be true. People will always want things to be faster. People always will want things to be easier. People always will want things to be risk-free. And if you can create an outcome that is desirable, fast, easy, and risk-free, then you have an incredibly valuable business. And so this corresponds with the value equation in the $100 million offers book. And so time delay is speed, ease is going to be your effort and sacrifice, perceived like of achievement is your risk, and then the dream outcome is making sure that you're not just making things fast, easy, and risk-free that no one wants, right? And so that's the dream outcome component. And so getting things to your door, a lot of people want that. If you can do it faster, they like that more. If you can make it easy for them, they like that even better. And if you can make it so that the purchase they had is very likely to be good, aka the entire review system that Amazon pioneered. Reviews were not a thing. Think about how crazy this is. They were not a thing, and a lot of people were afraid and pushed against Bezos when he wanted to roll out reviews because they were afraid that sellers would hate it. But he bet on the fact that customers long-term would want the transparency. So in Jeff Bezos' very first capital round that he raised, he sold 20% of the business for $1 million to around 50 investors. And so imagine the return on that today for that $1 million for 20% of Amazon. It's more than he still controls to this day, for context. And he took that to buy the initial inventory, get the website established, hire the first developers to get this going. And so if you're going to take on financial debt, use other people's money into your business. If you have a market that must be captured quickly in order to get a network effect of some sort, or you have huge amounts of capital that are required to make the business start to begin with. So if I wanted to start, call it a pharmaceutical business, then I would probably have to have capital for an extended period of time to start a new drug, to do the research, and then maybe 5 years after we get the licensing, then have the ability to print money. But that capital would have to come from somewhere. And so unless you start as a billionaire to begin with, which you absolutely could do that, hypothetically, but the vast majority of these businesses are not started by billionaires. They're started by everyday people who have a good idea. And then they go to people who have capital and say, hey, I will give you a piece of this upside. Now, this is the live fast, die hard style of making money. The reason it is that way is because it will typically be very investor favorable, especially the earlier it is, because they are taking on more risk. And so the big thing about these mega wealthy paths is that the underlying thing that occurs in all of this is 1, return on invested capital, and 2, the risk that you're taking in order to validate or justify that return. So some guy in 1995 says he's going to start a bookstore on the internet, whatever that is, and you give him $1 million, it's like, I need 20% of this thing at least because no one's ever done this before. You've never started a business before. What's the internet? And are people even going to buy stuff on it, right? So there are so many unknowns here that it makes sense that they had a tremendous amount of compensation for the veritable guarantee that they would lose the money they were going to give. And that's probably part of the reason that Jeff Bezos didn't just raise it from his friends and family, despite the fact he was a Wall Street insider. So he could have easily gotten the $1 million from probably a handful of people, but he also probably knew that there was a very low chance of success, which I think he says in his early interviews. He figured that there was a low chance of actually making this work. And so when you follow this path, the other people's money into your business path, there's really only 2 big kind of potential outcomes. One is, as a founder, you're going to de-risk along the way, which means that sometimes you will get something called secondary. So when an investor puts money into a business, they're going to appraise the business based on how quickly it's growing, how likely it is to continue to occur, and well, for them, the ease of investment is high because they just have to make the investment, but the fundamental value equation exists for them as an investor, where your business is the product itself. And so let's say that we have a business before the money that is worth, we'll call it $10 million. And then they say, I want to put $2 million into your business. So if they put $2 million into your business, this business is now a $12 million business where they now own 20%. And then everyone else now owns 80%. And so the founders, the original shareholders, are going to get diluted. It means that they now own a smaller percentage, but now the business has more capital that can help it grow. Now, a different path to this, if instead of putting $2 million into the business, they could have put, let's say, $1 million into the business and say, we're going to pay the founder over here into his personal bank account $1 million. And so that's called secondary. And then most people don't even say primary, but it's kind of almost assumed that money is going into the business when you're raising a round of funding. And so some founders will de-risk along the way because at some point, when you have a $1 billion asset and you have $100,000 in your bank account, some investors will understand that the founder themselves will become a little bit volatile. And so they want to give them a little bit of money so that they're not constantly freaking out and actually can make better quality decisions. So it's not uncommon for founders to take a little bit of chips off the table as they continue to scale and raise funding. Now, this is along the way they're making this money, but they still have this monster asset that's worth billions of dollars or hundreds of millions of dollars. And so there's basically two paths from there for them to actually get paid. Path one is that a big private equity firm, which is now kind of a new thing, is that there are some firms that can buy billion-dollar businesses and not have them be public. This is a new thing of probably the last, call it 7 to 10 years, where there's enough private funds and enough private money, sovereign wealth sometimes overseas, that can take down companies of this size. When I say take down, I mean put the capital in and buy it. So a simple example of this would be like a company like Kajabi, which is a learning platform where Tiger Capital came in and bought majority of the business, and the founders basically now minority, and they kind of had a full exit, and almost all of that cash went to the founders and very little into the business. And so in that setting, it's like they had a lot of capital, they bought this company, and so now they're, what's their exit? And so most of these paths, especially when you're raising funding, most of the time is going to be some IPO. So an initial public offering that then allows those shares to be made public, which allows the person who owns the whole pie and all the shareholders to have liquidity, meaning they have access that they can either sell those shares or they can lend against those shares. Either way, they have a way of making money from the business, not counting distributions, which many businesses that are like this don't ever give distributions because they continue to reinvest the capital in the business because the returns from reinvesting the capital are superior to just getting a dividend. And so one of the difficulties with raising money is the nature of the money that you take on. And so all of these are completely unique deals depending on the risk profile of the company, the risk appetite of the venture capital firm or whoever is making the investment, and what their investment thesis or philosophy is. And if you look at 100 different VCs, you'll have 100 different investment philosophies in terms of what they're thinking about. Now, all of them just want a big company, of course, but how they're going to get there is different. So there are some firms that only take on one company in a specific space, and they say, we're going all in on this company, and we're going to provide all the help we possibly can to help them grow. Right? There are some companies that say, we want exposure to this entire market, and we're going to take a bet on 10 different companies in this market with the hopes that one of them will win. So they don't even care that they're competitive. They just we want to make sure that we're with the winner, whoever the winner is. And so if you were in the latter example, each of those VC checks may say, well, we have to 10x this business in the next 2 years, or it's going to massively lose valuation. And so they will force the founders to take aggressive growth measures that may sometimes be not in the long-term benefit of A, the founder, but B, the business, which might mean that they're overspending on advertising, they're overhiring on talent, they let the culture get diluted or suffer because they can't have enough filters in place because of the rate or the pace of growth that they are requiring. And a lot of this growth is almost artificial because they're just injecting so much cash into advertising oftentimes to get the business to grow that they actually didn't solve the core fundamentals of the business. So one of the dark sides of this that doesn't get told is that as you do more and more rounds, each VC or venture capitalist oftentimes gets a board seat or 2 board seats. And all of a sudden you might find out that you have a minority of your business and you no longer have voting power, and you can get ousted from your own business from the investors that invested money in. And so a classic example of this was Steve Jobs. There was a period of time where he ended up getting kicked out of Apple for years before being able to come back. Now, mind you, at that point, it was still a public company and it had a board of directors, but it works the same way with a private company. I have a good friend of mine who exited, had enough of an exit. It was $1 billion valuation. He didn't get $1 billion, but he had enough of an exit that he could retire. And he continued to work, but then they just said, we don't want you to work here anymore. And so he got fired. And then 3 years later, they asked him to come back. And so it's very common to think, oh, this founder doesn't really know what he's doing. But the thing is, the founder always knows the heart and the pulse of the business because you're the one who knows each of the problems and why everything exists the way it does. In terms of wealth creation, when you take, let's say, 100 of these bets, you can get supremely wealthy. So believe it or not, venture capital is the highest returning asset class of all asset classes. The problem is the amount of capital that you can allocate into that asset class typically is very closed or very small because most of these funds and good companies are oversubscribed. There's many investors who want to put money in when these deals are really good, or the likelihood that the business succeeds feels really high. And so what happens is you may take 100 bets and the winner you have may offset the losses, but you're still never going to get richer than the guy who has a fully concentrated bet on the one business. And so there's 99 entrepreneurs who failed and didn't make money, but one of them who still gets even richer than the venture capital investors who put money in. They use that one winner to offset their losses, whereas if you were the only guy who went all in on that, you don't have losses to offset. You just went all in. And the reason you would take path one is because you have a business model that requires you to grow quickly or have tremendous amount of capital for an extended period of time before it could become profitable. And using other people's capital rather than saving up, let's say, 10 lifetimes worth of earnings to start a pharmaceutical company makes sense. If you've ever heard of like XYZ company raises money at a $500 million valuation, they're not saying they sold the company for $500 million. They're saying that the founders diluted themselves and the other investors by some percentage, and it could be as little as 1 or 2%, at that valuation. So for example, if you had a $500 million company and you sold 2% of that business, then you would have $10 million in cash that you could then put inside of the business to then help it grow. But you'd only sell 2% for that at that valuation. And so hopefully this puts some relative numbers to some things that you've heard before.